Welcome back, everyone. This is part 8 of our $1 Million Earner series, where we break down how high-income individuals can legally and strategically lower their tax burden under the big beautiful tax bill. If your annual income is around or above $1 million, this video is for you. We are going to unpack some of the most misunderstood sections of the tax code, which is real estate professional rules under section 469C7, and show you step by step how top earners are using them to turn paper losses into real spendable tax savings. Here's how we will break this down today. Part 1, the foundation, what the real estate professional REP rules actually require. Part 2, a real-life example of how a client applied this and saved 6 figures. Part 3, the practical strategy, how to qualify step by step. Part 4, how to involve this strategy into a long-term wealth system beyond 2026. Part 5, why it matters, especially for $1 billion earners. Part 6, a closing recap and next step you can take. So, stay with me through each section. I promise this will change the way you look at your real estate portfolio and your tax planning. Let's tackle part 1. So we want to understand the rules. So what does it mean to be a real estate professional? So let's start with the foundation, because this is where most people got stripped up. If your income level, passive loss, don't help you this year, you piled up, suspended, waiting for a future sale. But once you qualify as a real estate professional, the losses can become active and offset the W-2 or business income. Here's what the law actually says. You must meet 2 tests to be treated as real estate professional. First, you need to spend more than 750 hours during the year in real estate trades or businesses. Second, the real estate activities must represent more than half of all of the professional services you perform that year. That's it. So 2 clear thresholds. Now, real property trades or businesses include development, construction, acquisition, conversion, rental, operation, management, leasing, and brokerage. But investor type work like checking zero value or reviewing your property management statement doesn't count. And meeting the REP test alone isn't enough. You also have to materially participate in your rental activities. That's where the grouping election under Treasury Regulation 1.469(9)G comes in. This election allows you to treat all your rental as a single activity. That means your hour across property can be combined. A quick reality check. There's no new IRS rule requiring digital log for people earning over $1 million. But courts love contemporaneous documentation. So that means time-stamped records, emails, or logs showing what you did and when. So, how does this actually play out for someone like you, a high earner with multiple rentals and no time to spare? Let's move in for a real client story. This story is about turning passive losses into real tax savings. So Brandon and Melissa, a couple, work in Miami in early 2025. So Brandon is a private equity executive earning about $2.5 million a year in salary and K-1 income. Melissa manages family finances and oversees their real estate portfolio of 8 long-term rentals across Florida. For years, they had around $400,000 in annual depreciation losses. But because they didn't qualify as real estate professionals, the losses were suspended. They were literally sitting on the return like uncashed check. In February 2025, they decided to take action. Here's exactly how they did it step by step. Step 1. They restructure ownership. So they form a property management LLC to handle all rental operations. The LLC became the command center for rents, maintenance, and bookkeeping. Step 2. They documented every qualifying hour. Brendan and Melissa started using a digital time tracking app to log activities like tenant screenings, site visits, contractor coordination, and lease approvals. They include notes, dates, and even photos. Step 3. They make the grouping election. All 8 properties were combined into one activity. That was the key that allowed their hour to add up instead of being split apart. Step 4. They verify participation and intent. Every month, they meet to review property performance, profit margin, repairs, rent adjustment. They are an investor meeting. There was business management sessions. By December 2025, their time log saw 785 qualifying hours, with more than half of their work year spent on real estate management. So they met both the REP test and materially participated in the group activity. When we prepare the 2025 return in early 2026, those suspended losses become usable. The result, about $400,000 in losses, flow through as non-passive, reducing their taxable income and saving roughly about $148,000 in federal tax. Now that you have seen how that works in real life, let's go over how you can apply the same steps yourself, even if you are not full-time in real estate. Let's go to part 3, how to qualify. So here's your step-by-step. Before we dive into the checklist, so here's an important reminder. This isn't about pretending to be landlord. It's about building a system that meets our standards while keeping your real life in balance. Here's how to do it in 5 parts. So step 1, choose who will qualify. If you are married, only one spouse needs to meet the REP test. So high-income households, that often the spouse who already spend more time overseeing the properties. Step 2, make the grouping election. So file a statement with your tax return electing to treat all rentals as a single activity under Regulation 1.4699G. So the small paragraph on paper unlocks big leverage in power and participation. Step 3, operate like a business. Open a separate bank account, create an LLC to centralize decisions. Have regular check-ins with your property manager or vendor. Keep records of every expense, lease, and repair. Step 4, track hours continuously. So use an app or a spreadsheet. Document what you did, when you did it, and why it matters to the property profitability. Attract supporting notes like invoices approved, like tenant interaction or site visit. Step 5, focus on qualifying work. The IRS allows hours spent on direct management, supervision, lease decisions, and operations. Avoid counting investor time like researching the market or reviewing financial reports passively. Once you have these steps in play, you are not just a landlord anymore. You are operating a real business. But this isn't where it ends. Let's look at how to build on this foundation beyond 2026. So let's look at part 4, building a real estate operating company. So this next section is about scaling what you have started. If you already qualify as real estate professional, your next move is turning that activity into a full operating company. That's where the real wealth building starts. Here's how that evolution happens. You can expand into QBI eligibility because the big beautiful tax bill make the 20% qualified business income deduction permanent. So real estate operations that qualify as trade or businesses can reduce taxable income even further. Avoid verticals. If you bring maintenance, cleaning, or renovation work in-house, you can create deductible wages and legitimate retirement plan contribution like a solo 401k. Use cost segregation studies. So under the 2025 law, 100% bonus depreciation are reinstated for qualified 5 or 7 and 15-year assets. That means things like flooring, lighting, or appliances in your rentals can be immediately expensed, lowering your AGI while improving cash flow. You can include family members. Spouses or adult children can have managed rental, can be paid reasonable wages. That income stay in the family while creating retirement contribution under their names. So now you are not just managing rental, you are running a business that owns and operates real estate. And this changes the entire financial equation for high-income households. So part 5, the high earner advantage. Let's zoom out for a second. Why does this strategy matter most for $1 million earner? Because at this income level, your deductions are limited. Your phase out are constant and your effective tax rate is often at or near the top. You can claim many credits. You can't rely on standard deduction to make a difference. But when you activate your real estate portfolio, when those paper losses become active, suddenly you have control over timing. You decide when the losses hit your return, how much they offset, and when to reinvest. Every $100K in rental losses used this way can save $37,000 or more in taxes at top brackets. Sometimes more if you factor in state taxes. This is not a loophole, it's simply using the tax code as written the way serious investors do. So, if you have stayed with me this long, let's close with what to take away and how to act on this right now.